Well, where substantially all the risks and rewards incidental to ownership are transferred to the lessee, they should account for them as a finance lease. This means the equipment will appear as an asset and the liability to the lease payments as a loan on their balance sheet. Where substantially the risk and rewards remain with the lessor, they should account for them as an operating lease, charging the rentals to the profit and loss account. I wouldn't like to say that one is necessarily better than the other. They both receive full tax relief. The benefits of a lease for small companies and companies going through rapid growth are that they don't have to pay any upfront deposits and the payments are spread, helping their cash flow. Capital allowances are allowances given to businesses for the purchase of capital equipment such as computer equipment. They come in two forms, annual writing down allowance and the annual investment allowance, or AIAs. The current annual writing down allowance is 18% of the cost on a reducing balance basis. So it can take over 8 years before a business will receive full tax relief on 80% of the cost of the equipment. The current rate of annual investment allowance is 100% of the cost in the year of purchase, limited to £1 million of capital expenditure. The annual investment allowance limit was increased from £200,000 to £1 million from the 1st of January 2019. It could change again at the end of 2020. All businesses should give careful consideration as to whether they should purchase their equipment and claim capital allowances or lease the equipment. What's often overlooked is that the AIAs have to be shared amongst group companies, so not all the companies in the group may receive the allowance. Small companies have been required to prepare their financial statements under Financial Reporting Standard 102 since 2015. This requires them to account for their lease contracts as either operating leases or finance leases. Large companies such as PLCs have been subject to the same rules since 1st of January 2019. These changes were made to ensure that companies were showing their debts on their balance sheet. Well, there shouldn't be too much confusion for accountants, but there could be confusion for businesses. Because there is no numerical test to decide if an agreement is an operating lease or a finance lease, it's a judgment based on a number of indicators, so different people can come to different conclusions in different circumstances.